The Dow Jones was about to make history. It was minutes away from crossing 52,000 for the very first time ever. Investors were celebrating a record high. And then one man stepped up to a microphone and wiped out more than 500 points in a single afternoon. No crash, no disaster, no bad earnings. Just words. Today we're breaking down exactly what happened, why the market flipped so fast, and what it means for your money. First, let's understand the number because 52,000 on the Dow is staggering. Just a few years ago, crossing 40,000 felt historic. Now the market was knocking on 52,000's door. On June 16th, the Dow closed at 51,999.67. Read that again. It missed 52,000 by less than half a point. It was the second record close in a row. Wall Street was euphoric. The mood was pure confidence. Then came June 17th, and the name almost nobody was ready for, Kevin Warsh. This was his very first meeting as the new chairman of the Federal Reserve. Jerome Powell, the man who guided the Fed for years, was out. A new era had begun, and markets hate one thing more than bad news: uncertainty. Nobody knew exactly how Warsh would steer the most powerful financial institution on earth. Here's what the Fed actually decided. They held interest rates steady, keeping the benchmark in a range of 3.5 to 3.75%, unchanged since December. On paper, that is a non-event. Rates didn't move at all. So how does a do-nothing decision erase 500 points from the Dow? This is the part most people get wrong about the market, and it's the key to the whole story. The market doesn't trade on what the Fed does today. It trades on what the Fed signals about tomorrow. And the signal was brutal. Several Fed officials indicated they now see interest rates possibly going up later this year to fight stubborn inflation. The median forecast for where rates in 2026 jumped to 3.8%, up from 3.4% just a few months earlier. The direction had flipped. Think about what that means. Investors walked into the room expecting rate cuts on the horizon. They walked out being told the next move might actually be a hike. That single shift in expectations is what slammed the market. The Dow fell 507 points, almost a full percent, closing at 51,492. The dream of 52,000 evaporated in hours. The S&P 500 dropped 1.2%. The Nasdaq fell 1.3%. But the real action wasn't even in stocks. It was in the bond market, and this is where the money story gets deep. When the Fed turned hawkish, Treasury yields surged. The two-year Treasury yield jumped more than 16 basis points to 4.21% in a single session. That is a violent move for the bond market. And rising yields are like gravity for stock prices. Let me explain why. When safe government bonds suddenly pay more, investors ask a simple question. Why take the risk of stocks when I can earn over 4% risk-free? Money quietly rotates out of stocks and into bonds. At the same time, higher rates make borrowing more expensive for every company in America. Future profits get discounted harder. So when yields spike, stock valuations get squeezed. That's the machinery behind the drop. Now let's talk about why Kevin Warsh matters so much. A Fed chair is arguably the most powerful person in the global economy, more powerful in markets than any president. With a few sentences, the chair can move trillions of dollars. Warsh is known as a more hawkish voice, someone historically worried about inflation and skeptical of easy money. Wall Street was bracing to learn just how tough he would be. And on day one, he sent a message. Warsh didn't just hold rates. He announced new task forces to overhaul major Federal Reserve operations. Translation: this is not business as usual. A new sheriff is reshaping the institution from the inside. For markets that had grown comfortable under the old regime, that's both exciting and terrifying. Change at the top of the Fed ripples through every portfolio on Earth. Here's the paradox worth sitting with. The economy looked strong. The Dow was at record highs. Confidence was sky high. And yet the market tumbled anyway. Why? Because in finance, good news can become bad news. A strong economy means inflation pressure. Inflation pressure means the Fed stays tough. A tough Fed means higher rates. And higher rates mean lower stock prices. Success itself triggered the sell-off. This is the concept Wall Street calls good news is bad news, and it confuses everyday investors constantly. In a normal world, A booming economy lifts stocks. But when the central bank is fighting inflation, a booming economy scares it. Traders start rooting for weaker data because weak data means rate cuts. It's an upside-down logic that has dominated markets for years now. Let's zoom out and put the move in perspective. A 500-point drop sounds catastrophic, but on a Dow near 52,000, that's less than 1%. Years ago, 500 points was a heart attack. Today it's a Tuesday. As the index grows larger, the same point swings represent smaller percentages. So while the headline number looks scary, the actual damage was a modest single-day pullback from an all-time high. Still, the reversal matters because of what it reveals. The market had been pricing in a friendly Federal. It was leaning one direction hard. When reality contradicted that bet, the snapback was instant. This is the danger of a crowded trade. When everyone expects the same outcome and it doesn't arrive, the exit door gets very narrow, very fast. That's exactly what we watched unfold. So what does this mean for regular people, not just Wall Street? If you have a 401k or an index fund, you own a slice of this market. When the Dow drops, your retirement balance dips with it. But here's the perspective that matters. One hawkish Fed meeting is noise, not signal. The long-term trend of the market is built over decades, not single afternoons. Panic is the expensive emotion. Higher rates also touch your daily life directly. When the Fed stays tough, mortgage rates stay elevated. Car loans cost more. Credit card interest climbs. Savings accounts pay a little more, which is the silver lining. The Fed's fight against inflation isn't an abstract Wall Street game. It quietly reaches into every wallet in the country through the cost of borrowing money. Now, why is the Fed so obsessed with inflation that it would spook a record-breaking market? Because inflation is the silent thief. It erodes the value of every dollar you hold. Left unchecked, it can spiral and destroy savings. The Fed's entire mission is price stability. And to a hawk like Warsh, protecting the dollar's value is worth rattling the stock market in the short term. There's also a bigger backdrop here. Markets have been riding a powerful rally, fueled by optimism, strong tech earnings, and hopes that rate cuts were coming. Some analysts had even warned the rally was getting complacent, priced for perfection. When a market is priced for perfection, it only takes one imperfect headline to trigger a sharp repricing. Warsh's hawkish tone was that headline. Let's talk about the tug of war defining this market. On one side, a resilient economy and booming corporate profits pushing stocks up. On the other, a vigilant Fed and rising yields pulling them down. The Dow near 52,000 is the visible result of that battle. Every record high and every sharp drop is just the rope moving back and forth between those two enormous forces. So is this the start of a bigger decline, or just a blip? Honestly, nobody knows for certain, and anyone who claims otherwise is guessing. What we do know is that one of two things must give. Either inflation cools and the Fed can ease, sending stocks higher, or inflation stays hot, the Fed hikes, and the market faces more pressure. The data over the coming months will decide. Here's what smart investors do in moments like this. They don't try to time the exact top or bottom. They focus on what they control, their savings rate, their diversification, and their time horizon. A single Fed meeting rarely changes a sound long-term plan. The investors who panic sell on a 500-point day are usually the ones who regret it when a market recovers. It's worth remembering how often the market has done this exact dance. A hawkish surprise, a sharp drop, headlines screaming about a crash, and then, weeks later, new record highs. This pattern is repeated again and again. It doesn't mean a real downturn can never come. It means single-day drama is almost never the whole story. Context beats panic every single time. Let's give credit to what's still strong here. The Dow sitting near 52,000 reflects genuinely powerful underlying forces. Corporate earnings have been robust. Innovation, especially in technology and AI, is real. The American economy has repeatedly defied predictions of recession. This pullback happened from a position of strength, not weakness. That distinction matters enormously when you judge how worried to actually be. But there are real risks that deserve respect. If inflation proves sticky and Warsh follows through with hikes, the cheap money era that powered this rally truly ends. Highly valued growth stocks would feel it most. The market has been leaning on the assumption of falling rates. Take that assumption away, and some of these lofty valuations have a long way to fall. That's the bear case in one breath. What should you actually watch from here? 3 things. First, the inflation reports. Cooler numbers calm, the federal hotter numbers embolden the hawks. Second, the bond market. If yields keep climbing, expect more pressure on stocks. Third, Warsh himself. Every speech he gives will now move markets. Learn to read these 3 signals, and you'll understand this market better than most cable commentators. Step back, and there's a deeper truth in all of this. The stock market is not the economy. It's a giant voting machine on the future, and its biggest single influence is the price of money set by the Federal Reserve. When that price shifts, everything reprices. Understanding that one relationship between interest rates and asset prices unlocks most of what happens on Wall Street. And that's why a single afternoon with a new Fed chair could erase 500 points without a single bad earnings report. It wasn't about today's profits. It was about the future cost of money and the uncertainty of a new leader holding the controls. The Dow's near miss with 52,000 is a perfect snapshot of a market caught between record highs and a Fed that refuses to blink. So what does this leave us? The Dow flirted with history, then pulled back as a hawkish new Fed reset expectations overnight. Record highs and sharp drops are now 2 sides of the same coin. The market is strong but nervous, expensive but resilient, and entirely at the mercy of one number, the path of interest rates. That story is far from over. We'll be watching every twist, because in this economy the line between a record high and a sharp sell-off is razor thin. Will the Dow finally crack 52,000? Will Warsh actually hike, or was this just tough talk? The next few months will be electric for anyone who follows the money, and we'll break down every move as it happens. If this breakdown helped the market finally make sense, you need to be subscribed to Money Stories. We decode the biggest money dramas on the planet. The crashes, the records, the Fed, and the trillions moving behind the scenes. Hit that subscribe button, ring the bell, and drop a comment telling us where you think the Dow goes next. Up through 52,000 or down from here. See you in the next one.